Welcome to Windfall Edutech Intermediate Module, Chapter 3. Technical Analysis. What is technical analysis? History of technical analysis. Dow Analysis Theory. Basic assumption. TA. Support and resistance. Importance of trades in TA. Volume. Charts and its types. Popular chart patterns. Moving averages. Indicators and oscillators. What is technical analysis? A method of evaluating securities by analyzing statistics generated by market activity, such as past prices and volume. Some assets are unlike fundamental analysis, which attempts to measure intrinsic value. Technical analysis use charts and other tools to identify patterns that can suggest future activity easier to value than others. Also, the details of valuation may vary from asset to asset. Technical analysts believe that the historical performance of stocks and markets are indications of future performance. History of technical analysis. The principles of technical analysis derive from the observation of financial markets over hundreds of years. The oldest known hints of technical analysis appear in Joseph de la Vega's accounts of the Dutch markets in the 17th century. Dow theory is based on the collected writings of Dow Jones co-founder and editor Charles Dow, and inspired the use and development of modern technical analysis from the end of the 19th century. Other pioneers of analysis techniques include Ralph Nelson Elliott and William Delbert Gann, who developed their respective techniques in the early 20th century. Many more technical tools and theories have been developed and enhanced in recent decades, with an increasing emphasis on computer-assisted techniques. Dow Analysis Theory. A prominent technical analysis theory. Dow analysis is the popular analysis theory, which could be considered as the pioneer of technical analysis theory. The roots of technical analysis can be traced back to the Dow Analysis Theory. Dow Analysis Theory was conceptualized by Charles Dow, the editor of Wall Street Journal. Charles believed that stock market is a reliable indicator of the business conditions in the economy. Thus, analyzing the market would help us precisely gauge these conditions and thus helps us in identifying the direction of market trends and individual stocks. Dow Analysis Theory comprised of 6 sound principles. Stock market discount everything under the sun. There are 3 trends in the stock market, i.e., primary, secondary and minor. Averages must confirm each other. Volume shall confirm the trend. Trends definitely exist until and unless its reverse is confirmed. As per Charles Dow, there are 3 movements all going on at the same time. These are narrow movements, short swing and main movements. Daily fluctuations from day to day are termed as narrow movement. In case of short swing, secondary movements from 2 weeks to a month are covered. Whereas main movement is based on the primary trends that cover at least 4 years in duration. Although Dow analysis was conceptualized almost 100 years ago, many of its points are still relevant today. Many theories that have come after the Charles Dow theory have included several features of Dow theory. In fact, other theories have made quite a few significant contributions to the Dow theory. But, one cannot solely rely on Dow theory for their analysis. One of the key problems of the Dow theory is that the theory did not consist of any investment rules, as a result of which lot of assumptions and interpretations have to be taken into consideration. In addition, it is also difficult to predict the trend reversals or to gauge the temporary or major changes. There are many tools used in technical analysis that can help us to predict the reversal of trends, however its interpretation may vary from investor to investor. Basic assumptions in TA. Just as there are many investment styles on the fundamental side, there are also many different types of technical traders. Some rely on chart patterns, others use technical indicators and oscillators, and most use some combination of the two. In any case, technical analysts' exclusive use of historical price and volume data is what separates them from their fundamental counterparts. Unlike fundamental analysts, technical analysts don't care whether a stock is undervalued. The only thing that matters is a security's past trading data and what information this data can provide about where the security might move in the future. The field of technical analysis is based on 3 assumptions. 1. The market discounts everything. 2. Price moves in trends. 3. History tends to repeat itself. Market discounts is everything. A major criticism of technical analysis is that it only considers price movement, ignoring the fundamental factors of the company. However, technical analysis assumes that, at any given time, a stock's price reflects everything that has or could affect the company, including fundamental factors. Technical analysts believe that the company's fundamentals, along with broader economic factors and market psychology, are all priced into the stock, removing the need to actually consider these factors separately. This only leaves the analysis of price movement, which technical theory views as a product of the supply and demand for a particular stock in the market. Prices move in trends. In technical analysis, price movements are believed to follow trends. This means that after a trend has been established, the future price movement is more likely to be in the same direction as the trend than to be against it. Most technical trading strategies are based on this assumption. Another important idea in technical analysis is that history tends to repeat itself, mainly in terms of price movement. The repetitive nature of price movements is attributed to market psychology. In other words, market participants tend to provide a consistent reaction to similar market stimuli over time. Technical analysis uses chart patterns to analyze market movements and understand trends. Although many of these charts have been used for more than 100 years, they are still believed to be relevant because they illustrate patterns in price movements that often repeat themselves. TA. Support and resistance. TA talks about the ongoing battle between the bulls and the bears, or the struggle between buyers, demand, and sellers, supply. This is revealed by the prices a security seldom moves above resistance, or below, support. Every stock has resistance as well as support level. Resistance level is the level at which price is having resistance from buyers, and the support level is the level at which the price is having support from buyers. In short, resistance level is the level at which market stops rising as the sellers exceeds the no of buyers. Whereas in case of support level, market sees lot of buyers entering the market and rise due to that. These support and resistance levels are seen as important in terms of market psychology and supply and demand. Support and resistance levels are the levels at which a lot of traders are willing to buy the stock in the case of a support, or sell it in the case of resistance. When these trend lines are broken, the supply and demand and the psychology behind the stock's movements is thought to have shifted. Once a resistance or support level is broken, its role is reversed. If the price falls below a support level, that level will become resistance. If the price rises above a resistance level, it will often become support. As the price moves past a level of support or resistance, it is thought that supply and demand has shifted, causing the breached level to reverse its role. For a true reversal to occur, however, it is important that the price make a strong move through either the support or resistance. Importance of trends in TA. One of the most important concepts in technical analysis is that of trend. Trend is really nothing more than the general direction in which a security or market is headed. In any given chart, you will probably notice that prices do not tend to move in a straight line in any direction, but rather in a series of highs and lows. In technical analysis, it is the movement of the highs and lows that constitutes a trend. For example, an uptrend is classified as a series of higher highs and higher lows, while a downtrend is one of lower lows and lower highs. There are three types of trend. Uptrends. As the names imply, when each successive peak and trough is higher, it's referred to as an upward trend. Downtrends. If the peaks and troughs are getting lower, it's a downtrend. Sideways. When there is little movement up or down in the peaks and troughs, it's a sideways or horizontal trend. Trend lines. It is a simple charting technique that adds a line to a chart to represent the trend in the market or a stock. Drawing a trend line is as simple as drawing a straight line that follows a general trend. These lines are used to clearly show the trend and are also used in the identification of trend reversals. Channels. A channel, or channel lines, is the addition of two parallel trend lines that act as strong areas of support and resistance. Volume. While price is the primary item of concern in technical analysis, volume is also extremely important. Volume is simply the number of shares or contracts that trade over a given period of time, usually a day. The higher the volume, the more active the security. To determine the movement of the volume up or down, chartists look at the volume bars that can usually be found at the bottom of any chart. Volume bars illustrate how many shares have traded per period and show trends in the same way that prices do. Volume is an important aspect of technical analysis because it is used to confirm trends and chart patterns. Any price movement up or down with relatively high volume is seen as a stronger, more relevant move than a similar move with weak volume. Therefore, if you are looking at a large price movement, you should also examine the volume to see whether it tells the same story. Volume should move with the trend. If prices are moving in an upward trend, volume should increase, and vice versa. If the previous relationship between volume and price movement starts to deteriorate, it is usually a sign of weakness in the trend. If the stock is in an uptrend but the up trading days are marked with lower volume, it is a sign that the trend is starting to lose its legs and may soon end. When volume tells a different story, it is a case of divergence, which refers to a contradiction between two different indicators. The simplest example of divergence is a clear upward trend on declining volume. Chart and its types. In technical analysis, charts are similar to the charts that you see in any business setting. A chart is simply a graphical representation of a series of prices over a set time frame. There are several things that you should be aware of when looking at a chart, as these factors can affect the information that is provided. They include the time scale, the price scale and the price point properties used. The time scale refers to the range of dates at the bottom of the chart, which can vary from decades to seconds. The most frequently used time scales are intraday, daily, weekly, monthly, quarterly and annually. The price scale is on the right-hand side of the chart. It shows a stock's current price and compares it to past data points. If a price scale is constructed using a linear scale, the space between each price point is separated by an equal amount. In other words, the price scale measures moves in absolute terms and does not show the effects of percent change. If a price scale is in logarithmic terms, then the distance between points will be equal in terms of percent change. There are four main types of charts that are used by investors and traders depending on the information that they are seeking and their individual skill levels. Line chart, bar chart, candlestick chart, point and figure chart. Line chart. The line is formed by connecting the closing prices over the time frame. Line charts do not provide visual information of the trading range for the individual points such as the high, low and opening prices. The bar chart expands on the line chart by adding several more key pieces of information to each data point. The chart is made up of a series of vertical lines that represent each data point. This vertical line represents the high and low for the trading period, along with the closing price. Candlestick chart. The candlestick chart is similar to a bar chart, but it differs in the way that it is visually constructed. The difference comes in the formation of a wide bar on the vertical line, which illustrates the difference between the open and close. And, like bar charts, candlesticks also rely heavily on the use of colors to explain what has happened during the trading period. Point and figure chart. Point and figure chart is not well known or used by the average investor, but it has had a long history of use dating back to the first technical traders. This type of chart reflects price movements and is not as concerned about time and volume in the formulation of the points. Popular chart patterns. A chart pattern is a distinct formation on a stock chart that creates a trading signal, or a sign of future price movements. Chartists use these patterns to identify current trends and trend reversals and to trigger buy and sell signals. Head and shoulders, cup and handle, double tops and bottoms, triangles, flat and pennant, wedge, gaps, triple tops and bottoms, rounding bottom. Head and shoulders. This is one of the most popular and reliable chart patterns in technical analysis. Head and shoulders is a reversal chart pattern that, when formed, signals that the security is likely to move against the previous trend. Cup and handle. A cup and handle chart is a bullish continuation pattern in which the upward trend has paused but will continue in an upward direction once the pattern is confirmed. Double tops and bottoms. This chart pattern is another well-known pattern that signals a trend reversal. It is considered to be one of the most reliable and is commonly used. These patterns are formed after a sustained trend and signal to chartists that the trend is about to reverse. It is created when a price movement tests support or resistance levels twice and is unable to break through. It is often used to signal intermediate and long-term trend reversals. Triangles. They are some of the most well-known chart patterns used in technical analysis. Three types of triangles, which vary in construct and implication, are the symmetrical triangle, ascending and descending triangle, and are considered to last anywhere from a couple of weeks to several months. Flag and pennant. These two short-term chart patterns are continuation patterns that are formed when there is a sharp price movement followed by a generally sideways price movement. It is then completed upon another sharp price movement in the same direction as the move that started the trend. The patterns are generally thought to last from 1 to 3 weeks. Wedge. The wedge chart pattern can be either a continuation or reversal pattern. It is similar to a symmetrical triangle except that the wedge pattern slants in an upward or downward direction, while the symmetrical triangle generally shows a sideways movement. The other difference is that wedges tend to form over longer periods, usually between 3 and 6 months. Triple tops and bottoms. These are type of reversal chart pattern in chart analysis and are not as prevalent in charts as head and shoulders and double tops and bottoms, but they act in a similar fashion. Rounding bottom. A rounding bottom, also referred to as a saucer bottom, is a long-term reversal pattern that signals a shift from a downward trend to an upward trend. This pattern is traditionally thought to last anywhere from several months to several years. Moving averages. Most chart patterns show a lot of variation in price movement. This can make it difficult for traders to get an idea of a security's overall trend. One simple method traders use to combat this is to apply moving averages. A moving average is the average price of a security over a set amount of time. By plotting a security's average price, the price movement is smoothed out. Once the day-to-day fluctuations are removed, traders are better able to identify the true trend and increase the probability that it will work in their favor. Types of moving averages. Simple moving average SMA, linear weighted average, exponential moving average EMA. Simply moving average. It is the most common method used to calculate the moving average of prices. It simply takes the sum of all of the past closing prices over the time period and divides the result by the number of prices used in the calculation. Linear weighted average. This moving average indicator is the least common out of the three and is used to address the problem of the equal weighting. This is calculated by taking the sum of all the closing prices over a certain time period and multiplying them by the position of the data point and then dividing by the sum of the number of periods. Exponential moving average. The most important thing to remember about the exponential moving average is that it is more responsive to new information relative to the simple moving average. This responsiveness is one of the key factors of why this is the moving average of choice among many technical traders. Indicators and oscillators. Indicators are calculations based on the price and the volume of a security that measure such things as money flow, trends, volatility and momentum. Indicators are used as a secondary measure to the actual price movements and add additional information to the analysis of securities. Indicators are used in two main ways, to confirm price movement and the quality of chart patterns, and to form buy and sell signals. There are also two types of indicator constructions, those that fall in a bounded range and those that do not. The ones that are bound within a range are called oscillators. These are the most common type of indicators. Oscillator indicators have a range, for example between 0 and 100, and signal periods where the security is overbought, near 100, or oversold, near 0. Non-bounded indicators still form buy and sell signals along with displaying strength or weakness, but they vary in the way they do this. Accumulation distribution line. The accumulation distribution line is one of the more popular volume indicators that measures money flows in a security. This indicator attempts to measure the ratio of buying to selling by comparing the price movement of a period to the volume of that period. Average directional index. The average directional index (ADX) is a trend indicator that is used to measure the strength of a current trend. The indicator is seldom used to identify the direction of the current trend, but can identify the momentum behind trends. ARUN. The ARUN indicator is a relatively new technical indicator that was created in 1995. The ARUN is a trending indicator used to measure whether a security is in an uptrend or downtrend and the magnitude of that trend. The indicator is also used to predict when a new trend is beginning. ARUN oscillator. An expansion of the ARUN is the ARUN oscillator, which simply plots the difference between the ARUN up and down lines by subtracting the two lines. This line is then plotted between a range of -100 and 100. Moving average convergence. The moving average convergence divergence (MACD) is one of the most well-known and used indicators in technical analysis. This indicator is comprised of two exponential moving averages, which help to measure momentum in the security. The MACD is simply the difference between these two moving averages plotted against a centerline. Relative Strength Index. The Relative Strength Index (RSI) is another one of the most used and well-known momentum indicators in technical analysis. RSI helps to signal overbought and oversold conditions in a security. On balance volume. The moving on balance volume (OBV) indicator is a well-known technical indicator that reflects movements in volume. It is also one of the simplest volume indicators to compute and understand. Leverage convergence divergence (MACD) is one of the most well-known and used indicators in technical analysis. Stochastic oscillator. The stochastic oscillator is one of the most recognized momentum indicators used in technical analysis. The idea behind this indicator is that in an uptrend, in downtrends, the price should be closing near the lows of the trading range, signaling downward momentum. Thank you. Revise and get ready for the next